Welcome to the Other Side of Wall Street with your host, Ron Harrison.
Good morning, everyone. Welcome to the Other Side of Wall Street. My name is Ron Harrison. I'll be your host for today. And if you've been following along with us in prior weeks' episodes, you'll know that we have first started out trying to educate you in the all aspects of trading psychology and what your emotions can do to affect your trade results. And then we moved into option basics, talking about how options are constructed, how they're priced, how they work. And now I think it's time to actually start getting into some practical applications of all that and talk about how we trade and what we do. Now, if you remember in my first episode, I explained to you how once I managed to work my way into one of the larger firms on Wall Street and actually was working for them, trading their money, a light bulb went off. The aha moment occurred, however you want to put it. And I really discovered the difference between what the firms do with their money and what the firms have their brokers do with your money, the retail client's money. Totally 180 degrees difference. And of course, I'm talking about the department that I was in, which was the options department. So what I teach now is basically what I learned there. So the crux of that is options, and even more specifically, it is selling options, not buying them. So as I've also said in past episodes, you'll know that if you look it up online or anywhere else, you'll find that option trading is an extremely risky endeavor in the markets. It's, I think the stats are that if about 90% of all money spent buying options is lost by the buyer. And that's by design, not by chance, because options were originally designed and incorporated into the markets to facilitate the gamblers out there, not the investors, not the people that are buying stocks and holding them, not the Warren Buffett type, not the mom and pop, buy some shares of John Deere and hold on to it for 20 years. Not those people, but the gamblers, the people that were going to Vegas, people that were going to Atlantic City, people that are betting on horses and dogs and whatever, the gamblers. So as in any other kind of form of gambling, it's you got a high degree of losing your money, which is how it works. That's what it's designed to do. But as with anything else, if you have this option mechanism and it has a 90% chance of losing for the buyer, there has to be the opposite side of that deal. So the opposite side of the deal is the seller. In this case, where I was, it was the brokerage houses. And that's when I first realized that there's not much difference between Vegas and the brokerage industry, and that being that the house always wins. So in this case, the sellers of options have the corresponding 90% chance of success on every trade, which is much better odds than the buyers who have a 90% chance of losing on every trade. So that is what we're going to get into now, is selling options. So prior to explaining the core strategies that I've been using with actually great success over the years, I would like to state that the fact that options are different than stocks. So just because you think the stock is going to go up or going to go down, you just can't go out and buy any old option and expect it to be able to make money. Again, remember, we were looking at this from the option buyer's viewpoint at this point. So we're looking at it as if we were an option buyer. Options are sensitive not only to direction, but also to time left before expiration and how volatile the stock market is. So stocks trading is a one-directional endeavor. Again, stock trading is a one-dimensional endeavor. Price is the only factor, and its direction is either up or down, and that's it. No place else can it go. Now, options, on the other hand, are three-dimensional. So we need to factor in three factors. We discovered price, time, and volatility. So again, options are three-dimensional, not one-dimensional as stocks. And you need to factor in the three factors, which are price, time, and volatility, and we went through those in prior lessons. When you purchase a stock, you establish a cost basis. That price point is made up of what you paid for the stock plus commissions. Now, most of the buy and hold investors wait it out over years, many years, to see if the stock goes above their cost basis or break even. And these people have the advantage of time. They're not in a hurry. They can just wait it out. Now, options, on the other hand, are much different. They have a finite date of existence. So if the stock price does not move above their break-even point by expiration, they lose the entire price they paid for their option. And this is the reason you should never purchase an option hoping for a quick profit. This is the game that the brokers play on a daily basis. They target the unknowledgeable traders or the gamblers with a trading instrument that is relatively cheap and carries the promise, as with all gambling, however faint, of the possibility of greater profits. And this is where we come in. Option selling. So what you want to do here is allow yourself to become the house. So selling options, when done correctly, can give you an overwhelming advantage in the market. And don't confuse the strategy of selling options with having a bearish directional position if you're used to stocks and you think that if you sell a stock or short a stock, you're bearish. Not the same here at all. They're totally unrelated. We're talking about selling options instead of buying stocks. It is by far one of the best ways to put the probability of profit on your side. So we sell options in 95% of our trades because of this high probability of success. And we will show you that a huge advantage for selling options rather than buying them is that picking the correct direction of the stock is not the driving force to being profitable. Again, picking the correct direction of the stock is not the driving force to be profitable. We can still produce a winner even if the wrong direction is what happens. The biggest downfall for most option buyers is that they just can't pick the correct direction in the time allotted for option trade. Because remember, options have a specific lifespan. They are going to expire. And if the stock does not move to the point that they want it to move to in the time before the option expires, then they lose everything they spent, which is hence the 90% chance that we talked about. Selling options give you a huge margin for error in your directional assessment. So many of the option buyers rely on their directional guess as the only way to give them a profitable trade in the time allotted before the option expires. And this is an extremely hard task to accomplish with options. Another major enemy of the option buyer is one of the biggest factors in our favor, and that's the concept of time decay. So as an option buyer, time decay is one obstacle that you have to face every day. And again, as an option buyer, time decay is an obstacle you have to face every day. Time decay is a characteristic of options that describes the erosion of its price, causing it to lose a little bit of its value each day, regardless of whether the underlying stock price moves or not. So when the option buyer purchases his option and the stock does not move up to the strike price that he predicted, each day that ticks by, a little bit of the value of that option is lost. Each day, another piece is lost. And that goes on day after day until you get to the expiration date. And then if the stock has still not moved to the price that he predicted it wanted to be, he's lost everything, which happens almost the majority of the time, let's just say. But hence, since we collected our money up front when we sold the option, time decay is working in our favor. This is especially evident in the out of the money. This is especially evident in the out of the money options. Now that you remember, we discussed this in past sessions, that these out of the money options are the ones that most of the option gamblers like to purchase due to the fact that they are cheap. And remember, that's how gamblers work. They don't want to put a lot of money down. They want to put a small amount of money down, cross their fingers, and hope that something goes drastically in their favor and they make a big reward. So when you buy out of the money options, you're paying for something that has no real or intrinsic value. Remember, we talked about intrinsic value a couple shows ago. So again, when you buy an out of the money option, you're paying for something that has no real or intrinsic value. I like to say we sell junk. In our classes, I make a joke about the old TV series Sanford and Sons, and that's what he did. He was a junk dealer. That's what we do. We sell junk. We sell things that have zero value, except for time value. You are buying something that is entirely priced on the value of volatility and the amount of time left before expiration. So the only value that option have is, again, time value, which I like to call hope value. So that's the amount of time that the gambler can cross his fingers and hope that the stock moves in the right direction and the right amount in that direction. So that's all we're getting out of that is time value. And as each day passes, the option is still out of the money. The premium will be repriced to a lower amount. And this is time decay in action. So if you have experience buying options, then you may be aware of this issue. But many of you novice traders don't fully understand this concept. So once again, I would like to express that time decay is one of the option sellers' biggest allies. Since we are only selling out of the money options, we are merely selling time. And as we have just stated, one thing you can count on is that time will expire. We can't stop the clock from moving. So if there's nothing else, you can be sure that each day that goes by, 1 day of time value is lost for the option buyer, and that is gained by the option seller. So probabilities. One thing that many option buyers tend to forget is that the option trading is a game of probabilities, as is actually all trading. Option pricing is based on mathematical and statistical models, and you can figure out ahead of time the exact level of probability that your option has of being profitable. So I've said this in other episodes, but I want to state it again. The option buyer has only one way to win with their option trade. The stock has to move in the right direction in the time allotted before expiration. But for the option seller, there are actually 3 scenarios for you to be profitable: if the market moves higher, moves lower, or stays flat. So these 3 scenarios for us to profit compared to the buyer who has only one chance to be right. Once again, you decide which side you want to be on. So determining your factor of probability. There are 2 ways for you to determine your factor of probability. The first is with the probability calculator. But most of us don't have one of those, and if we did, it would require gathering a lot of information, and it would just be far more trouble than it's worth. And this is really more than I'd want to do for any option, actually. So there is a much easier way, and that is to just look at your option table within your trading platform. Many trading platforms will give you the option of displaying the probability of expiring feature. And this column, as with all data displayed on all trading platforms, is given from the option buyer's view. Now, there are some platforms out there like Thinkorswim that we use, Tasty Trade, their platform, Tastyworks, that does it. But it's a few of them give it to you from the seller side, majority of them give it to you from the buyer's side. So us sellers, we need to reverse what we see for our purpose if you're on one of the other platforms, which is being the seller. So at this point, we're up to our first break. Let's take that break and come back, and we'll continue.
Here's another look into the world of trading.
Hey traders, want to jumpstart your trading? Well, I would assume that since you're listening to this podcast that your answer would be yes. And as they said in The Godfather, what if we made you an offer you can't refuse? And that's exactly what we're going to do. How would you like it if we gave you all the trades we make in our own accounts in real time so you could trade right along with us and profit as we do? And what if we met once a week for an hour to discuss our current trades, any other trades you may have open, plus discuss any problems you may be having in general with your trading? And that's 1 full hour of group coaching each week. Also, what if we threw in an additional 1/2 hour of private one-on-one coaching each month to privately work on issues you may be having with your trading? It could be things you didn't feel like sharing in the group sessions. Also, what if we threw in a weekly end-of-week market review analyzing the past week's market and what to look forward to for the upcoming trading week? That will be delivered to your inbox every Friday after market close. And what if we threw in a free copy of our latest book, Reprogramming the Trader's Mindset, to help you get your trading emotions of fear and greed back in control? And what if we also sent you our monthly newsletter packed with trading tips and upcoming market events? That would be very useful, I'm sure. And to cap it all off, What if we gave you a 30% discount on all of our live 3-day trading seminars? So altogether, this adds up to $1,269 in monthly value, plus another $1,680 in course discounts to use whenever you like. And if you think all this sounds good, then you must realize that this is a very powerful addition to your trading business. And as with any business, in the beginning, you will need a mentor or support team to help your business grow and to keep you on track to achieve your maximum trading potential. So the small cost to this extensive package is only $49 per month. And of course, you can cancel at any time, but since you will be making far more than the cost of the program by just copying our trades, we doubt you're going to want to cancel. So don't wait any longer. Sign up today. Go to tradersacademy.org. Again, that's www.tradersacademy.org. And do it soon because memberships are limited. And it's our promise to you that if you copy all of our trades and you don't make at least double the first month what you paid, we'll gladly refund your subscription payment. So join us, and together, let's make some money. Okay, we're back. And before the break, we were talking about determining your factor of probability. And I was stating that with some platforms, you can actually have it display the probability of expiring out of the money. And for all the rest of them, they're going to show you if it's going to expire in the money. And it's according to which platform you're on, whether or not you have to do what we're going to talk about now. But let's look at it from the worst case scenario that you're on one of the other platforms. And in that case, you'll need to reverse what you see for our purpose, which is for us, we are selling, not buying, because most of the platforms display that from the buyer's perspective. Now, this figure that we're talking about will display a percentage number. And this percentage will be the percentage that the buyer has for the option to close in the money on expiration day. Remember, it has to be in the money on expiration day for him to make money. If it stays out of the money and remains that way until expiration, he loses everything. So remember, we're going to need to reverse this for our purposes. So let's say, for example, that we look at LVS and see that it's trading at 48.50. These are just fictitious numbers. We look to sell the 44 put against it. When we look at our options table, we see that the option has a 21.74% chance of expiring in the money. Now, as option sellers, we do not want this option to expire in the money. The buyer does, but we don't. We're selling them. We want it to expire out of the money, which will result in it expiring worthless. The purchaser, the gambler, loses everything that he paid for it. We keep everything. So we will need to reverse that 21.74 number for our purposes to see that we now have a 78.26% chance of this option expiring worthless. So I have a rule of thumb that I like to use is not to place an option trade unless I can see at least a 65% chance of it expiring out of the money. At least 65. Typically I go higher than that, but 65 is my absolute bottom number. So one thing that you must have before you place any option selling play is you must have an initial directional call. If you don't have a plan or some kind of trading methodology to give you a directional call, you should never take an option position of any kind. You can't just blindly do this. So in future episodes, we'll look at chart reading as a way to predict both direction and the level we think that the stock will not drop below. Again, remember, we only need to predict where the stock price will not go. The option buyer has to predict exactly where it will go, and not just that, but in what time frame it will take to achieve it. So our way is much, much easier. So now let's look at a specific strategy. This will be the first one we look at, which is actually the simplest one. And that is called covered calls. So what you want to do is put your stocks to work. So we mentioned in the beginning that about the buy and hold people that buy the stocks and just lock them away and wait years for them to gain in value. But there's a better way to play that same game after you buy the stock. And you want to put your stocks to work. Let them earn money for you as you're holding them. So if you own stocks and you're just holding them in your account, then you're leaving free money on the table each and every month. So you may not realize this, but there are other traders out there who would love to give you money today for the right to take your stock away from you if it reaches a much higher price. So selling covered calls is such a great strategy for generating steady monthly income that I still can't believe that there are investors who aren't taking advantage of this. So it's one of the best ways to take in extra cash that you never knew you could have. So we're talking about earning income just for the fact that you happen to be long the stock in your account. So by selling covered calls, you can inflate your portfolio while you hope and wait for the stock to go up in price, which is what you would have been doing anyway as a buy and hold trader. So here is strategy number 1, the first of 3 core option selling strategies that we're going to cover, and one that falls into the hedging and income producing category. And you'll be surprised to see, once you've employed the strategy for a few months, how fast the cash will start to add up. So here are the components. Let's break it down. There are 2 ways to approach covered calls. You can sell one call option against every 100 shares of stock you already have in your account. So remember we talked about that earlier on. Every option represents 100 shares of stock. So if you sell one option, you've got to have 100 shares to back it. And you can also buy the stock and sell covered calls against it all in one transaction. This is called a buy right, because you buy the stock and write the covered call against the stock at the same time, same trade, same click of a button. You need to understand that you can be much more proactive with your account and add incredible amounts of passive income every month of the year. So understand that there are investors or traders out there who are willing to give you money today for the right to buy your stock at a higher price than you paid for it. This money is the option premium. We've talked about that already too. That the call buyer will pay you for the option, they'll pay you, the option seller. So when you sell covered calls, you're giving someone the right to possibly take your stock away from you sometime in the future. Now at this point, some of you are thinking to yourself that I don't want to sell stocks to anybody. I like them. They're part of my family. I'm keeping them. But throughout this course, I will try and convince you that holding on to stocks for the long term is not the way to grow your account balance. To be really successful trading the markets, you need to always be aware of profits that you can take. So if you owned a hardware store or any other kind of retail business, would you stock your shelves, lock the door, and hope that the value of your products will gain in value before you sell them? No, of course not. And people would think you were crazy if you did. So why would generating income from stock market be any different? But just to ease your mind, we're going to focus on the best way to sell covered calls that minimizes the danger of losing your stock. Now, the buyer of your call option, remember you're the seller, pays you cash today, which is the premium, for the right to possibly take your stock away at a later date at a higher price than it's trading at today. So many of these buyers are purchasing short-dated, out-of-the-money options, low probability calls. Time decay will be eating away at them, and that is why we have the huge advantage we have because of time factor decay. But I know some of you are thinking, why would anyone want to take a chance of losing their stock and potentially miss out on future upward movements? So first, let's cover the reasons. Someone is giving you good money to do it. That's one reason. Number 2, like we've covered in the past sessions, your chance of losing your stock is lower because of the fact that you are selling out-of-the-money options. These are cheap options that most option traders, gamblers like to buy because they cost very little, but also have very little chance of expiring in the money. Remember, we're selling options that are worthless, basically. The old saying goes, you will never go broke taking profits, and that's true. You should try and convince yourself not to fall in love with the concept of owning stocks. If you really want to make as much money for yourself as you can, then you need to focus on the percentage return you're getting on your trading capital and not get hung up on just plain owning the stock. Remember the hardware store. You need to generate cash flow to have successful business. So can you afford to wait another 10 years to see where your stock is trading? Well, look how well you did during the past 10 years. And last but not least, another benefit of covered calls is that by doing this on a monthly basis, it will reduce your cost basis on the stock. So by the amount of the option premium you collected, it's like someone is giving you a rebate on your long shares of stock. So if you sell covered calls for a long enough period of time, your cost basis could eventually reach 0. So how's that done? So let's look at an example. Now, what I did was I went back and I picked the time period. So I picked from 2000 to 2010, which I happen to know was a period of time to where wherever your stock price was in 2000, it was pretty much at the same price in 2010. So basically, we had a whole decade of ended up where it started. So we made nothing, or the long-term investors made nothing. So let's look at this example. So let's say you owned 1,000 shares of Microsoft. Let's also assume you bought it in 2000 for $27.30 a share. Now, these prices are actually pretty accurate because I went back and did the research. So let's look at how you have done so far. If you did nothing but place your 1,000 shares in your account, we are now at January 2011. Microsoft is currently trading at $27.06. And remember, we bought it at $27.30. 10 years later, it's at $27.06 a share. And those are true numbers. Not too good for the buy and hold strategy, huh? 10 years and you still haven't made any money on your investment, which has, by the way, cost you $27,300 for those 1,000 shares. So you probably could have used that money to invest in something else, or at least buy yourself something nice. And since I've made it a point to state that no one knows what the market's going to do, and how do you can assume that just buying stocks will turn out to be profitable? We can't, because we don't know, and that's exactly my point. Okay, now let's look at the same purchase of 1,000 shares of Microsoft, except this time doing it our way. Our purchase price is still the same, $27.30, and our time frame is still 2000 to 2011. And the current price is still $27.06. But now for this example, we'll assume that the option prices from Microsoft have remained about the same. And since we have no way of going back 11 years and getting exact prices for 120 months, you can also safely assume that since the stock price had remained about the same during this period of time, that the option prices would have done the same also. Now, since our original cost basis is the $27.30 we paid, we will start there. So if we look at current Microsoft option chain, we can see that the $30 strike price option is going for 23 cents per share. So you times that by 100, and you'd receive $23 per option contract. And since we have 1,000 shares, we need to multiply that by 10, because now we can do 10 options, for a total of $230. So based on this, we can assume that we would have collected about $230 each month that we've owned Microsoft. Now, I know that you're thinking that during that past 11 years, at some point, Microsoft would have surely topped $30. Well, that's true, but I'm basing my figures on selling out-of-the-money options that are $3 out of the money. So as Microsoft moved in price, we could simply adjust our strike price to stay ahead of the current price by the $3 margin. Since we're always selling the closest in-month options, we have the advantage of readjusting our strike price on a monthly basis. So now back to our example. We originally purchased Microsoft at $27.30 per share. We can assume that we could have generated about $230 each month by selling 10 $30 strike price near-term options each month. So let's also assume that we had a full 10 years to do this. Since 2011 just started, we're only in January in this hypothetical example, which would give us 120 months of option selling in our Microsoft stock. So let's do the math. 230 times 120 months, that equals $27,600 in option premium that we would have collected. Now, if you remember, we only spent a total of $27,300 to purchase the stock originally, and we have, through monthly selling of covered calls, generated $27,600. So we've now regained the entire price we paid for the stock, plus an additional $300 to boot. And let's not forget that we still have the Microsoft stock that is worth $27,060 based on today's current market price. So you tell me which method you'd rather trade by. The buy and hold, end up 10 years later, slightly lower than where you actually started, or selling covered calls monthly and end up with your entire investment return with an additional $300 and you still own the stock. So what happens if you get a sign? I'm sure you're going to ask that question. It's no biggie. If you happen to get a sign on your call option and you're forced to sell your stock, then so be it. But you still come out ahead. Not only did you make $230 each month that your stock did not get called away from you, but you also have a gain on the stock from your original purchase price of $27.30. Because remember, you sold it at $30. That's $22,700 gain on the stock. So selling out of the money covered calls forces you to take some profits along the way, assuming you're selling calls with strike prices above your initial stock buy price. Another point about adjusted cost basis. I want to touch on again the topic of strike price versus cost basis. As you sell covered calls each month, after a month, your cost basis begins to decline, and you may be tempted to sell strike prices lower to generate more premium income. And you can do this and generate larger monthly premiums, and yes, as long as you stay ahead of your cost basis, you'll realize the profit if you're assigned. That's all true. But But what you need to keep in mind is that as far as your broker is concerned, they will show on your statement a realized loss in that transaction. Remember, the only way we see that you purchased and what you sold the stock for, that's all they see. They see the purchase price and the sell price. They don't add in any premium you collected along the way, so they do not adjust your cost basis. So you would actually show a loss in your account on the stock trade itself. You show profit on the option premium collected, but your stock trade would show a loss, but that would not be actually the case. So keep in mind that if you don't want to show a loss on paper, be careful what strike price you pick. Never go below your original stock purchase price, although that loss could go help in taxes. You never know. But if you have been selling covered calls against your stock for many months or even years and your cost basis is well below where you purchased the stock originally, then you may want to let your stock position get assigned at a lower price. And this will result in a loss on your brokerage statement, even though you're really in a profit position. But you can now use this loss to offset other gains that you may have at tax time. Manage your risk. Always risk I can't talk today. Your risk management plan with a covered call strategy is no different than your normal long stock plan. No matter how much the calls will shield you from a down move in the stock, it won't shield you from a total loss if the stock falls to zero. So those two risks are the same. If you own shares of stock, what were the reasons behind your original decision to purchase them? How far are you willing to allow the price to drop before you stop believing in the reasons you had to purchase the stock in the first place? So do you have a stop loss point? Do you have a profit taking point? So are you watching support and resistance levels on the charts? Whatever your plan is or was to just make sure you continue to follow it. Remember, don't fall in love with the stock. Your only goal should be to make profit in whatever time you're given. So in summary, selling out of the money call options against long stock positions is a way to gain additional income while you wait for an eventful profit-taking sell price to be reached. So if you really want to hold on to the stock, then you will need to concentrate on selling even further out of the money calls because it will lessen the chance of getting assigned. So as a hedging play, covered calls are the best way to offset the ups and downs we all go through while owning stock. So you might as well incorporate a system that will produce you with some extra cash every month to buffer the potential fall of your stock price. Not to mention pad your account along the way. Now, we've been talking about selling monthly options, but most stocks now have weekly options. So instead of doing this monthly, you can actually do it weekly. And by doing it weekly, that gives you even more opportunity to adjust your strike prices. So as the stock price moves, each week you can readjust where you're going to place your covered call. So as the stock starts creeping up and you start worrying about getting closer to being assigned, when that week is over, just inch your stock price, your strike price up each week. And then if the stock price drops off, you can bring it back down. But as opposed to doing it monthly, which will give you a larger one-time premium, but I believe you'd find that if you add up the weekly ones, that is actually going to come out ahead. So that's a much better way to do it. So remember, this money is out there waiting for you to collect every month. So why would you not want to take it? So that's it for today. I hope this example helped you. Hope it got you a little excited about doing this. And in coming weeks, we're going to cover more strategies and start getting deeper and deeper into how to sell options. So thanks for joining us, and we'll be back next week. And if you want more information, please go to tradersacademy.org. That's tradersacademy.org. We have a lot of nice things there we're offering. So check it out. Again, tradersacademy.org. Otherwise, we'll see you next week. Thanks.